Welcome to The Explainer. Today, we're going to jump right in and decode the tax audit. We'll be zeroing in on one of the most critical parts for any business, the official expense filter that decides which of your costs are actually allowed by the tax man.
So, let's kick things off with a question that, trips up a lot of business owners. You look at your financial statements, you see a nice, healthy profit, but then your accountant tells you your taxable profit is a totally different number, and yeah, it's usually higher. So what in the world is going on?
Well, the answer is you're kind of playing two different games at the same time, each with its own rulebook. Your book profit is all about standard accounting principles, giving a true and fair view of your business's health. But taxable profit, that's a whole different beast, calculated strictly according to the Income Tax Act. And the bridge between these two worlds, the process that gets you to that final taxable number, is the tax audit.
And that brings us right to the role of the tax audit. It's not just about someone checking your addition and subtraction. No, this is a deep, formal review that puts your accounts right up against the letter of the law.
See, if your business's turnover crosses a certain threshold, the law says you have to get this audit done by a chartered accountant. All the findings get laid out in one super detailed report called Form 3CD. Think of this form as the official blueprint, the thing that maps your company's reality onto the government's tax rules.
And bang! Right at the heart of that report, we find the real engine of the whole expense review, Clause 21. This is that powerful expense filter we just talked about. Its entire job is to seek and find specific costs that, even though they're perfectly legit in your own books, are just not deductible for tax purposes.
All right, so how does this expense filter actually work? Let's break down the main kinds of spending it's programmed to catch.
Okay, first things first. The filter's initial job is to knock out two huge categories of spending that the tax code says have nothing to do with your day-to-day operations. This is the most basic check.
First up, capital expenditure. We're talking about the big stuff, the items that give you a long-term benefit, like buying a new building or some heavy machinery. They're assets, not daily running costs. Then you've got personal expenditure. Basically, anything with zero business purpose, like, paying for a family trip on the company credit card. The filter flags them both and pulls them right out.
And this quote from a court ruling? It's the perfect litmus test. The question is simple. Does this spending create an enduring benefit for the business? A new delivery truck? Yes. Enduring benefit. That's capital. The gasoline you put in it every day? Nope, that's a regular expense. Your auditor uses this exact same logic.
But it's not just what you spent money on. After that, the audit filter gets really interested in how you paid for it. Believe it or not, your payment method is a huge deal under tax law.
Get this number into your head. 10,000 rupees. It sounds like a small amount, right? But it has absolutely massive consequences. It is the hard limit for what you can pay for a single expense to a single person in a single day if you're using cash.
And the rule for this, Section 40A3, doesn't mess around. If you pay even 1 rupee over that 10,000 limit in cash, the entire expense gets disallowed. You can't deduct any of it. The government's message here is crystal clear. They want every transaction documented, traceable, and in the banking system.
Next, the filter puts on a special pair of glasses to look at payments to what the law calls specified persons. We're talking relatives, company directors, people like that. The rule isn't you can't pay them. The rule is about fairness. The auditor has to check. Was the payment reasonable? Or was it way more than you'd pay a stranger for the same thing? It's a check against using family connections to unfairly lower your profits.
Okay, so we've talked about your spending. But now, for a twist. The audit filter checks something totally different. How well you did your job as a tax collector. For a lot of payments, like rent, professional fees, or commissions, you are legally required to deduct tax at source, or TDS, before you pay the other person. So, what happens if you don't?
Well, the penalties are pretty severe. If you fail to deduct TDS on a payment to someone living in India, 30% of that expense is disallowed from your books. And get this, if that payment goes to a non-resident, boom,
A full 100% is disallowed. The entire expense is gone from your deductions. It's a huge incentive to get it right.
And it doesn't stop there. Clause 21 has a whole laundry list of other specific no-nos. Things like taking out an ad in a political party's brochure, paying for club memberships and fees, and this is a big one, any fines or penalties you had to pay for breaking the law. The tax code says, sorry, those are not the cost of doing business.
Okay, I know. This level of detail can seem almost obsessive, right? But there's a really important reason for all of it. This isn't just about collecting tax. It's about something much, much bigger for the whole economy. You know, there's a line in the official guide that's written for the auditors themselves, and it just says it all. The tax audit process is pivotal for transparency, accountability, and trust. It's really about maintaining the integrity of the whole system.
And at the end of the day, that's what the Clause 21 filter is all about. It makes sure that your taxable profit isn't just some random number. It's a figure that's been calculated using a standard, consistent set of rules that applies to everybody. That builds trust, not just with the tax department, but with banks, investors, and the public. It makes the whole system more fair.
And this leaves us with a final question to think about. As our economy gets more complex, you've got crypto, the global gig economy, remote work. How is this expense filter going to keep up? What new kinds of expenses are going to start testing these old rules? One thing's for sure, it's a system that has to keep evolving. Thanks for joining us on The Explainer.